All righty, we back. We back like we never left. How's everybody doing, man? God is good. God is good. Before we start today, let's read this daily devotional. You know, I like to start my day like that. We are, however, going to do the part 2 of our investing course. I got this thing, it's ready to go. We ready. We ready. And the link is in the description as well on the last live if you've not gotten it. Matter of fact, I should probably I ain't gonna do that right now. All right, let's do this this daily devotional. Short and sweet. Love the Lord your God with all your heart and with all your soul and with all your mind and with all your strength. Mark chapter 12, verse 30. One more time. Love the Lord your God with all your heart and with all your soul and with all your mind and with all your strength. For God, life is all about relationships. When Jesus had the chance to sum up what it's all about in only a few words, this is what he said. Damn, people be asking what the meaning of life is, right? Let's go one more time. For God, life is all about relationships. When Jesus had the chance to sum up what it's all about in only a few words, this is what he said. Friends, it's all about reconciliation and a relationship with God. All you need to do is love God with everything you've got. That's the biggest life secret. Everything that aids you in this life, in this called life, I give you this life. Don't think God is interested in religion. He couldn't be bothered by it. He is a God of the heart and love and relationships. To know him is the biggest joy any person can ever experience. Don't rob yourself of this joy and fulfillment. And so you say, wonderful Father, my Father, I want to love you with all I've got. I don't want to withhold anything from you. If there's anything holding me back, please save me from it. I want to fully live the life you intended for me to live. Amen. I love these daily devotionals, man. I feel like so much weight lifted off my shoulder already, baby. Y'all ready to get started here? Let's see if there's anybody in the chat, man. I need some fire emojis. Oh, there ain't nobody on this thing. That's okay. That's okay. Let's get started with this live. All right, hold on one second, y'all. Because I want to update my all right. Yeah, I think that works. All right, we're just going to wait till some people pop in here, and then we'll get started here. Damn, Tesla doing numbers. All right, you know what? I've been waiting to do this because I haven't had the time. I mean, because I wanted to do it live with you guys. So I'm going to do it now. I'm going to go ahead and get into a couple positions. I got into one this morning. I got into HIMS because it was down like 4%, 3 or 4%. So I got into HIMS, started selling puts on it. Let's see what we got here. So yeah, I'm down 10% right now on that put that I sold. But let me go to my watch list. So I have a watch list of the stocks that I like to sell puts on. And Hood might be a good one. SoFi is a good one. I'm about to get into all these again. Damn, Tesla's booming. I should have got in when I could have. I should have gotten in sooner, but freak it. Let's get in. Let's see what kind of returns we're going to get here. Let's go to the 20 Delta. The price right now is $347. Man, I had bought this shit, bro, like when it was in the damn 200s. All right, we're looking at a 330. Let's go 332 and a half. Let me write these down. Let me write these down real quick. So we're going strike of 332 and a half. That's my strike. My premium is $2.83. That delta is, I think, a 21, I think. Let's see what kind of return we're looking at here. So 100 divided by 332 and a half times 2.83. No, that ain't working. Let's do that one more time. Yeah, that ain't gonna work. That's not gonna work. It's too hot right now. Let's see what this 330 looks like. 100 divided by 330 times the premium on that is 229. Yeah, and there's nothing to buy there. All right, so, oh no, I'm tripping. My bad, guys. I was looking on the wrong date. I would look for June 13th probably, because that's 29 or 30 days out. So let's redo this again. So June 13 is what I'm looking at. I'm going to go down to my let me see. 0.2 is 305 is my strike. My premium is going to be, there we go. That's looking better. It's going to be $7.80. That's a 0.2 delta. Let's do the math on that. 100 divided by 305 times 7.8, 2.5% return. So we're going to go ahead and do that trade. So that's the 305, 780. Let me see, how many contracts can I afford? I'm going to do one contract. All right, order placed. As you guys can see, my order is placed. Now what I'm going to do here is I'm going to get into SoFi and Hood probably. I'm liking SoFi. So let's look at SoFi real quick. SoFi is at $14.08. Whoops. 1408 is the stock price. So let's open up the options chain here. June 13th is my expiration date. We're going to head down to 0.2. That's the 1250. I like that price. The strike is 1250. The premium at 1250 is a quarter. Okay. Now let's do the math on that. We've got 100 divided by 1250 times 0.25. You're looking at a 2. I'm not going to get greedy. I'm going to go ahead and do that. That's a 2% return. That's what we want. So let's go market and let's go with how many contracts? Nope. We're going to have to go with like 20 minimum. I'll do 20. I'm going to do 20 contracts on SoFi. So I got 20 contracts on that. That's probably going to be a 2% return. And then let's look at Hood. Hood is down 1.5 points. So I'm going to open up my options chain here. Again, June 13th. June 13th. The price is $61.62. Head down to the delta of 0.2. That's $54 is the strike. I don't mind that one. The premium is on 54 is $1.44. Let's do the math on that. All right, we got a 2.66 return. I'll go ahead and do that one. So that's 54 at $1.44. What's the bid ask? Doesn't even say. Let's see. Let's put 1 in the quantity. Yeah, the spread's not bad, so I'm just gonna do a market order. And then let's do how many contracts? Let's see what 2 is. Nope. Let's try 5. All right, that works. All right. Hood is placed. So I did 5 contracts of that. All right. So I think I'm good with these trades right here. NVIDIA is booming right now, but I think I'm good with that. I don't want to get too greedy. So these are my positions now. And I'm down on everything, including hood. Right away. We out of there with hood. But that's all right. Tomorrow it'll look different, and by the end of the month it'll look different as well. So I'm not too worried about it. All right, let's go ahead and let's get into the actual course at hand. Hey Georgie, if you're watching this, maybe that could be like you could put that towards the back end of this. So I'm gonna go ahead and start the intro to this course. All right, guys, so we are getting started here. At the end of this video, you'll see me do some live trades. Based on what's going on with the market, I see it's bullish as hell. I don't think it's gonna slow down for a little bit, for a couple of weeks, maybe less, maybe longer, I don't know. But these are all stocks I'm willing to keep anyways. So as long as I feel like I got a good price on them and the return, the risk is worth it, we're gonna go for it. With that being said, we made those trades, and so I'm gonna sit on those for, you know, I think the expiration date on them is for next month for 30 days. So you'll see the trades live at the end of this video. And these are not recommendations. Do your own due diligence. All right. Cool. Let's go ahead and let's go back to the course. And where we left off last time, we finished module 5. Let's head over to module 6. And like I said, some of this is a refresher for me. It's been a while. I mean, I've been in some trouble with selling puts, but the long term, I was able to wait it out and not be assigned stocks. So this is going to be a refresher for me, definitely. So we're learning together. All right. What's up, man? Well, I'll show you later on what that looks like with small caps and stuff. Okay. All right, let's get to module 6. What to do when assigned stocks. So what happens when you're assigned? The stock fell below your strike price. So some of the trades that I did just now, I shared the strike price. If it falls below that number, by the time that contract expires, I'm going to have to purchase those stocks. So if the stocks, if the strike price was $100, I better have $10,000 in collateral in my brokerage account where I can cover it and take those stocks. Now, once you have to do that, what's next? So you got to have a mindset shift. People get too scared, right? And let me zoom in just in case you guys can't read. You got to remember that you didn't lose. You just bought a stock you already wanted at a discount. So you just need to stay calm. This is where the strategy gets fun. You'll see the shares in your account and your cash collateral is now stock. Okay. So you'll see your cash, your buying power go down, but in your portfolio, you'll see the shares in your account. It should be 100 shares of whatever stock you sold puts on. And so your new job is to make that stock work for you with covered calls or long-term holds. It's up to you. You can go and do a covered call, or you can just hold them and ride the wave back up. Okay. If you, and that's what you expect. You shouldn't expect anything else. If you did expect something else, then you shouldn't have sold puts on it. Okay. Now, let's talk about holding versus selling. Why we choose companies we love. There's two paths. You can hold the shares long-term if you believe in the company, which we should. That's the only reason why we're getting in. And then we should sell the shares if the thesis changes or you have better opportunities. So just because you were assigned those shares, if something changed with the fundamentals, you might have to sell it, right? But that's okay, because you're going to use that capital to get into better opportunities. It's not like you lost. If it's a good company, you're not going to lose your hat, okay? This is why we only sell puts on great companies. If assigned, we're happy with it. If not, we keep the premium. Every assignment is a chance to level up, not a mistake, all right? In the perfect world, we don't want to be assigned because we just keep collecting premium, right? Just keep collecting premium. In a perfect world, you collect the premium a week, 3 weeks early, and you get back into the same plane. You just keep collecting premium. But if you are assigned the stocks, you can still be profitable. I can't stress that enough, if you do this the right way. All right. So if you plan to hold them long term, you really don't need to do anything. But if you want to keep cash flowing, here's what you can do. You use covered calls to keep cash flowing. Covered calls is a premium generator, just like selling puts. You own 100 shares. Now you can sell a covered call on them because the 100 shares is your underlying asset. It is the collateral, okay? So you sell a call at strike price. You'd be happy to sell the shares for. So now it's the opposite. When you sold puts, you were selling the puts. You were selling the puts at a strike price you'd be happy to purchase them at. When you're selling a call at a strike price, when you're selling a call, you're choosing a strike price you'd be happy to sell the shares for. So if you own Apple at $100, sell a $110 call and collect $2 a share in premium. If Apple stays under $110, you keep your shares and the premium. And by the way, your shares might be growing, because if it grows to $109, you're still profiting off of the shares and you're collecting premium. If Apple goes over, then you sell the shares at $110, you still make a profit and you collected the premium. This creates ongoing income, just like selling puts did. Isn't this genius? So when to take profit versus when to keep holding. If the fundamentals change, let's say, like, I don't know if you guys have been following what's going on with United Healthcare. Fundamentals definitely change there. I might want to get out of that thing. If you have a better stock to rotate into, let's say something happened that had nothing to do with the company and Tesla went crashing down for whatever reason. You might want to just sell that stock because Tesla's might be a better opportunity if you have the conviction. And if the price has run up significantly and you want to lock in the gains, okay? That's if you just have the shares and you're not selling covered calls. The price runs up significantly, might as well sell it, lock in the gains, get out of it, because we have a base and we have a plan. So we need to stick to it, all right? When to keep holding. You believe the stock has more upside. You want to keep selling covered calls, or you like the dividend and long-term outlook. There's no wrong answer. Just make sure every move has intention. You should be playing chess, thinking 5 moves ahead, and this strategy gives you so many options to play with. So you're playing chess, and you know what pieces you have, you know what moves you can make, and you know you can't lose if you are intentional. Okay? And so this is the assignment playbook. Scenario, you're assigned shares. That means you own 100 plus shares of a stock. You evaluate your thesis. If you still believe in it, you keep it. If not, you sell it. You can sell a covered calls or you can just keep it. But if you sell a covered call, then the strike price needs to be the target sell price. And then you reinvest the proceeds into your base. All right. So let me see if I can make this like a visual representation. All right. So remember, you're still creating a flywheel. So first we sold puts. I'm sorry. Let me go back to my actual flywheel. Let me see if I have, nope, that's not it. Is it here? No. Trying to find the flywheel that I had originally. There she is. Okay. So remember, your main income, your dollar cost averaging into your brokerage account and to your base. Showed you already how to automate that. If you don't know how to automate that, go back to that video. I think that's number 2, lesson number 2. All right. Then you sell puts, you collect the premium, and then the premium, I like to do realize. Some people just right away take the premium and put it into their base. Okay. And it's just a flywheel. But there's one more step that we didn't cover. Just want to make this a little bit smaller so I have some space here. Okay. The last step here is if you're assigned, you can hold or sell covered calls. And guess what? You're going to collect a premium again, just like you did when you sold puts, and you're going to put the premium in the base. And so the flywheel continues. It's just a longer distance. That's the strategy. That's the plan. Any questions on this, guys? So this is module 6. This is what you do when you're assigned shares. If you sold puts and you're assigned the shares, this is what you do. That's module 6. All right. Now, let's go into module 7. So this is all great, but you might be wondering, this is cool, but I don't even know what companies I should be investing in. All right. I showed you guys my watch list. I'll show you guys again. Most people, when they're doing options, they like tech companies because it's volatile. All right. And a lot of times the value business, the value companies, the reason why they're value stocks is because nobody's paying attention to them most of the time. So if nobody's paying attention to them, it's hard to sell options in. So value investing, although it could work, right? Like you can see a tech company that the PEG ratio is screaming undervalued and there's still some volatility. There's still some volume in there as far as options is concerned. Yeah, that's a win-win-win-win, right? But nonetheless, I want to show you guys how to evaluate or how to analyze companies. Now, like I showed you guys, here's my watch list. And this is always evolving. Google right now is undervalued in my opinion. A lot of people are scared with AI that Google's going to get crushed, but Google's a huge company, guys. You have HIMS, Hood, NVIDIA, Palantir, QQQ, SoFi, Tesla, TSM, and VOO. All right, that's my watch list. You don't need to copy me. You need to come up with your own. But if you want a good start, you can start with that. So how do we analyze these companies? This is the great business checklist. All right, check it out. Here's the traits of a great company. Strong and growing revenue, high return on equity, 15% or more is the sweet spot, consistent profit margins, low debt relative to cash flow, brand strength or economic moat, excellent leadership and culture. If you'd be proud to own 100 shares forever, it's a great candidate. Apple being one of those probably for you. Tesla is one for me. Microsoft might be one for you. Coca-Cola might be one at the right price. There's a lot of brands that you use every day that you probably been buying products from your whole life. And so if the financials line up, if you like the CEO, if you like the forecast of the company in the future, it's probably a great company to get into if it's the right price. And so what I like to do is I like to use a website called qualtrim.com. It's only $10 a month. Honestly, the value for this is insane. I learned a lot from the owner of this website. Let me see if I can find him. Because I always forget his name, but I learned so much from him. So I need to give him a proper shout out. There he is. Joseph Carlson. So here's his website. Here's his YouTube channel, guys. Wealth of knowledge. Guys, he's got a portfolio of $840,000 in his portfolio. And I don't think he does options. I think he just buys great companies. That's all he does, is from my understanding. So great, as far as, understanding companies and valuing companies, great guy to follow. Great guy to follow. There's a reason why he has 457,000 subscribers. So this is his website. It's $10 a month. And in my opinion, it is worth every penny. Makes it very, very easy for anyone to invest. So right off the bat on Insights, you'll see the S&P 500. You'll see the most trending stocks. You can see HIMS is on there, SoFi. This is a great place to start if you're looking for companies that you can sell puts on. And so we'll come in here and we'll look at, because they're trending, another one is growth, okay? But if they're trending, there's probably a lot of volume going on here. So for example, let's look at, and depending on how much money you have in your brokerage account, you're probably better off with the cheaper stocks. SoFi is a huge one for selling options, okay? Because it's only $14 a share. Rocket Lab might be a good one. Damn, it's up almost 10% today. Interesting. Might need to put that on the watch list. Let's look at this company, okay? So if we go look at our cheat sheet, and we need to do some research on this company because it's a fairly new company. So remember, we said strong and growing revenue. Let's see if this one checks the box. What do you have here? Strong and growing revenue, okay? That's a good sign. And then you have high return on equity. Well, you can see earnings per share. You can see it's not a very profitable company. We don't know why, okay? It is a new company, but it has no free cash flow. It just has promising revenues. It's not a profitable company. It has no profit margin. This is probably a company that might be one of those early, I don't know anything about it, but I guarantee you if we do some research, and I'm going to write it down, some deeper research, this could be like a Palantir or something. And I'm not saying it's similar to that company, but it could be, as far as growth, a company that's not profitable yet, but has a lot of promise. And that's why it's trading with an $11 billion market cap. All right. So here's like a brief explanation of it. You definitely got to do better research than this. And one of the ways that I do it is go look at the transcripts of the earnings calls. But I also watch a bunch of YouTube videos on it and stuff too. I go and look at what social media thinks about it because it matters. Shares of companies within the broader industrial sector are trading higher amid overall market strength following softer than expected April and blah, blah, blah. Okay, so again, I'm not quite sure. This tells you competitive advantages. This tells you the investment risk. You can see analyst estimates. So the industry is aerospace and defense. So I can go to the website. I can learn about the company. But it seems like it was close to Palantir type of company, and I didn't even mean to do that. Employees is growing. It's probably a company with a lot of promise, but there's an opportunity cost here. If you like it, you could probably, at $11 billion, this company might grow to $200 billion, in a few years. Who knows? It's probably good to watch this company and learn about the company because this might be a future opportunity. All right. It's trending for a reason. But let's go to an actual company that's worth looking at. So this is Microsoft. $450 is too much. Let's go to SoFi. So this is the company that I just sold puts on. You guys can see the price is down from January to $14. The low this year was about $10. Okay. My strike price that I locked in is at $12.50. So, it could easily drop below $12.50 in the next month or so. But it has. But I think it's a bullish market right now, especially after all the news that we've seen. And I don't think momentum's gonna stop in the next 30 days. It could, but do I think it's gonna go up and maybe drop below $12.50? Probably not. That's my bet anyways. And there's an 80% chance I'm gonna win this, just based on the delta that I chose. But if you notice, it checks the first box. Revenue is crushing. Members. This is a KPI. The members continue to grow. It is a profitable company. Look at the EBITDA. Free cash flow is growing. Let's look at it from a quarterly basis. Okay. You guys can see it had one strong quarter, but it's almost there, right? Remember, this is a tech company, so we're not that worried for a tech company this new to be profitable. But if it continues these revenues, it's going to do great because look at the net income. Net income's $500 million. What did it do with its free cash flow? I mean, what did it do with the net income? We can look at expenses and we can see marketing was $800 million. R&D was $550 million. OpEx was $600 million. That's what G&A is. CapEx was $154 million. Okay. So a lot of money in research and development. That's a good sign of a growing company. And I know a lot about this company. I know the CEO. I think this is a great company. This is another good sign. Employees are growing. Another good sign is if they're buying back stocks, they're not. They're a new company. So not a new company, but they're raising shares because, well, they're growing the company. Let's look at their cash and their debt. You can see their debt is $1.78 billion, but they have $2.5 billion in cash. They can pay this off right now. If they didn't have enough cash to cover this, I would look at how much net income they have, and they would be able to pay this back in the next few years. So I'm not stressed about the financials of this company. The profit margins are okay, but there's a lot of potential. This is a $15 billion company. This can be a couple $100 billion company in a few years. Damn, it's dropped to $14. Now I wish I would have sold some puts later on, but it's all good. I think I'm good no matter what. We remember $12.50 is the strike price. So in the next 30 days, will it drop before that? And even if it does, can I maintain above $12.50 the next 30 days? I think I can. I think I can. Okay. So if we go back to our checklist, well, we know there's consistent profit margin. We know there's high return on equity. We know there's low debt relative to cash flow. We know that it has brand strength. The economic moat is there as well because they're a little bit different than what Robinhood is doing. One of the things about SoFi is that they have a deeper connection with their clients because they're more so a bank, and a lot of their clients have loans with SoFi, so they're not going anywhere. And then the CEO is amazing, excellent leadership and culture. So I'm good with this company. It checks all the boxes. So I reviewed the financials, the balance sheet. Now, the way that I do the balance sheet, because this is the cash, this is not the assets under management. This is cash. Here's the thing, though. SoFi is not like the type of company that's going to have a bunch of inventory and assets under management. So I'm good with just seeing this, how much cash versus debt. all together. This is the balance sheet, okay? So this looks good as well. Now, if it was a company like, let's say, a Zara or a what's that furniture store? IKEA, right? I would want to know what AUM is. So I would just go to ChatGPT and I would do something like this. What is AUM of IKEA? Let's see what it says. ChatGPT is a game changer. So it says it doesn't publicly disclose this, okay? But total assets or whatever is 22.5 billion. This is probably wrong, okay? Tell me about their balance sheet. It'll probably even pull up the balance sheet. Sometimes when a lot of stocks get overlooked because a lot of people don't check the balance sheet. All right. And so here you go. Here's the balance sheet. You can see total assets, fixed assets, and then you can see the total liabilities, right? And so this company's definitely in good standing because the liabilities do not outweigh the assets, all right? And you can even click on here. It'll take you to the actual website. So shout out to ChatGPT for making that happen. All right. Once you've discovered that it's a good candidate and it passes all of these check marks, we'll go to valuation basics. We're going to look at intrinsic value versus the market price. You got to understand that what the company is worth versus what the market price is can be completely different. The market price could be cheap, could be lower than what you think it's valued at. So again, price is what you pay, value is what you get. And so intrinsic value is what a business is actually worth based on earnings, cash flow, etc. And the balance sheet, right? Market price is what people are willing to pay today. Sometimes a tweet could be the reason why a stock goes down, but it's worth way more. Sometimes rumors that you knowing aren't true because you use the product, right? Or you use the service. Or I don't even want to say that, but you get what I'm saying. So anyways, you buy when the price is less than value. And you can do this also with the S&P 500. You can do this also with indexes, with the QQQ. You can do it with those. You can look at PE ratios for those. And if the PE ratio is low, you might want to buy it. Or you can also look at the earnings, the EPS, the earnings per share of that index, and match it with the price of the stock. And you might see that the index is worth a lot more than it's priced at. So when you see something's undervalued, you sell puts when the price is around the value and you're okay owning it. The reason why is because we can always, let's say it's right at a fair value. Well, we're going to put a strike price that's well below the fair value. That way, if it does dip by a little bit, we're still going to collect the premium. This is why it's important to understand what the value of that company is. So you can use Qualtrics valuation summaries to compare historical earnings versus market price. Look for fair value discrepancies. I'll say this too. Sometimes, even if it's overpriced, if you see something is trending and people are constantly talking about it, social media is a good indicator that Wall Street doesn't pay attention to, and it gives small investors like us a bit of an edge. If something has a shit ton of volume, bro, it doesn't matter if it's fair value or if it's overpriced. Chances are it's not going to go lower in price. We've seen it a million times. And one of the ways you can do that as well is using Google Trends. So Google Trends is a great way to see, how much volume a certain stock is getting. So like, let's do SoFi stock. And let's see. So you guys can see the interest right now is pretty damn high. It was at its highest right here. Oh no, this is May. Let's look at not the past day. Let's look at the past 30 days. So it's pretty high right now. SoFi stock, right? Here, it wasn't that high. Here, it's very high. So we know there's a lot of interest in it. I think that's a good indicator. Again, these are just add-ons, just to make you feel like you have even more conviction. So Google Trends is definitely a tool. There's a guy, I don't know if you've seen the YouTube channel called Dumb Money. I would definitely recommend go checking out that YouTube channel. All he does is social arbitrage, is what he calls it. And let me show you that YouTube channel. So this YouTube channel right here, Dumb Money or Dumb Money Live, they have a regular channel as well. Bro, these guys, this guy right here has made millions. All of them are millionaires on this channel, and they just did it through businesses and investing, just like I'm showing you guys now. So I highly recommend you guys check out their channel, and I'll react to a lot of their videos as well, just because they're so insightful. They make investing so fun. Okay. Now, let's actually start trying to value these companies, because it's cool to look at the financials, to look at a company and see that, hey, this is probably a good buy. But let's actually understand how to value a company. All right. So in this lesson, we're gonna learn how to use PE ratio, growth rates, and free cash flow. So PE ratios are price to earnings. It tells you how expensive the stock is compared to its earnings, compared with industry peers. Okay. So when you're using PE ratios, you don't match a PE ratio from, let's say, Nike and compare it to Nvidia. They're completely two different industries. They're going to trade with different PE ratios. All right. You got to do it closer to apples. So you could do Nike with Skechers if you want to. It doesn't have to be exactly the same. It just needs to be in the same industry. There's people who would even do Nike next to Gap, the Gap, for example, because it's in the consumer retail clothing space. All right. Another one you can use is PEG ratio, which is PE divided by growth rate. This adjusts valuations based on growth. So under 1 equals likely undervalued. So for regular companies, regular industries like Coca-Cola, Nike, stuff like that, we're going to use PE ratios, okay? But for tech companies, growth-based companies, new startups, like new companies that are growing, we're going to use PEG ratio, because these companies are priced based on their future, all right? Free cash flow is the cash left after operations and investments. So consistent free cash flow equals strong financial health. Let me show you what that looks like. I think Amazon has some really good free cash flow. Let me just make sure. Well, right now they do. So let's take a look at Amazon on this screen. So you can see their revenues is consistently growing. Their EBITDA, which is their earnings before interest, taxes, depreciation, amortization, that keeps growing. They had 2 down years with their free cash flow, but you know that after your EBITDA, after your net income, what's left is your free cash flow. And free cash flow is what's left that you can give back to the investors in the form of dividends. You can use it to buy back shares, right? There's all kinds of things that people can do with the free cash flow. This is a good sign of a healthy company, especially if it continues to grow. Sometimes that's annually, but sometimes you want to look at this quarterly just to see how it's probably going to do next month. And sometimes there's a pattern here, and it's based on seasonal things, okay? So you got to look out for that as well. That's free cash flow. So what I like to use Qualtrim for this is to visualize the historical PE and growth trends and dive into the FCF breakdowns in the financials tab. And so, like, if you really wanted to look at the free cash flow, we can go deeper in here and we can just chat GPT this. And this is why, guys, I create a watch list. You don't need to know every stock in the world. You just need to know a handful of stocks really, really well. And then just keep selling puts on the same stocks. Okay. And so just like that, by chat GPT, we can come in and we can get a better idea of what is going on with the free cash flow. All right, strategic, all that good stuff. This is the type of research you want to do on your favorite companies. Cool. Now, I've shown you guys how you can go directly to a company's website and find a lot of their financials by going to the investor relations tab. Let me give you an idea of what that looks like from a different company. So like even your favorite brands like Home Depot. This is Home Depot. If you scroll all the way to the bottom, you'll see investor relations. And here you can learn a lot of things about the company. You can see all their financial reports if you wanted to. It's always good to double check because you never know how these third-party websites are pulling their data. Sometimes the data could be wrong. So it's always good to just in case check that out. But you can also chat GPT their financials as well. Now, I like to use things like Qualtrim because it's a one-stop shop for all my financials and it's quick. And so I can quickly look at things. And then when I see something nice, then I can go do deep dives. You can go to sec.gov or directly to their website to find the 10Ks and the 10Qs. Seeking Alpha to listen to earnings calls, but Qualtrim allows you to do that as well. I told you guys, if you go to Qualtrim and you go to transcripts, we can go to Home Depot and it'll use AI and you can just kind of read what the last one was, but you can do full transcript here. I like to, let's say I look at the transcript summary and I like what I see here, then I'll go actually listen to the call. I'll actually go listen to it. All right. If you want to go actually listen to it, you can use things like Seeking Alpha, but a lot of times it's on YouTube or on their website as well. Guru Focus is cool. Go check that out on your own time. A lot of cool metrics on there. FinViz is great. It has like a filter to find good stocks, and I'll show you how if you need a free filter, I think FinViz has a free filter, and we'll talk about filters in just a bit. Okay, and so here's Buffett's principles. Simple, understandable businesses, a strong moat and pricing power, consistent earnings and strong return on equity, fair price and long runway for growth. A lot of this stuff is common sense, guys. It doesn't have to be that hard. All right. And so here's your checklist. Number one, you want to evaluate the company quality. Number two, you want to compare the intrinsic value to the market price. You want to look at the PE, the PEG, the FCF for valuation clarity. You want to review the long-term financials on Qualtrim or whatever resources you can find. And then you're going to decide, are you going to sell a put on it? Or are you going to wait for a better price? Do you want to buy the stock directly? It's up to you what style you do. I don't buy the stocks directly right away unless it's like an obvious no-brainer, a slam dunk. I don't do that. I usually just stick to the blueprint. Base, sell puts, sell covered calls. Flywheel. That's what I do. Okay? But you should still know how to analyze companies and value them. Okie dokie. That was module 7. I hope that helps you guys. Let me see if there's any questions here. Yeah, so I'll show you guys. I'll show you in just a bit, Leo, some small caps. Fubo and Honest are up 10% since the last time we were talking about them. Everything's up 10% right now, Leo. Everything. I'm looking for stuff that I like that's down, because that's what I'm trying to sell puts on. Have I looked at Square? Oh, I love Square as a company. I've not looked at their financials in a while. That's a good question. We can check out Square. You guys want to do that while we're here doing this? And then Joel asks, should I move my savings from my money market to a brokerage? What I recommend is you start from square one. If you're just catching this course now, go look at the first part of the live stream. If you go to my main channel, you'll see clips of each of the sections. I haven't broke it down into lessons, just like a course. And what I do is I move a certain amount of my savings to my brokerage, and then from there on out, my brokerage account is my savings account, because I collect 4.5% interest, and it just makes it easier to go ahead and invest rather than having to transfer money from your savings, wait 5 days, and then you can invest it. But then by then you missed out on a whole bunch of profits, right? Okay. Now, before I go look at Square, I have it written down. I want to show you guys, I showed you guys how to analyze a company, right? Now, and how to do like a brief valuation of a company, but let's really value these companies now. Now, we've really gone through everything. We looked at the CEO, we like it, YouTube videos, we looked at the financials, we listened to the earnings calls, we like the company. Now we're going to value the company, all right? So there is a 3-question filter. This is going to remove 95% of stocks. Here's the 3 questions. Will the company grow over the next 5 years? You got to look at revenue, earnings, and macro trends. If there's no growth, if there's no growth coming, it's probably a value trap. And we've seen this, for example, with certain stocks during the pandemic. There was some stocks that thrived a lot because of the pandemic, but we knew they weren't going to be able to keep that trajectory. And a lot of people were buying those stocks with that being priced in already, without that being priced in. And then once it was priced in, huge decline, but you bought it at the peak, okay? So you got to be careful with value traps. So you have to feel like the growth is going to continue for the next 5 years. If not, it's a value trap. Will the company have a PE under 15 based on next year's earnings? Helps avoid overpaying for average companies, number one. Number two, for tech stocks, you don't use PE. You want to use PEG ratio instead, okay? Very important. Because if you use PE for a tech stock, you're not going to buy any tech stocks. None of them. Because none of them are trading at 15. I mean, there are some, but those aren't the ones that are growing, all right? PEG focuses on growth. Do you trust the CEO? And honestly, the CEO doesn't have to be the next freaking Elon Musk. I mean, some people wouldn't even use Elon Musk. Jeff Bezos, the next, Apple CEO, Tim Cook. They don't need to be that. They just need to not be the CEO of Nikola, where they're going to literally destroy your company by themselves. You don't want an con man who has a rap sheet of fraud running your company, all right? This simple filter eliminates 95% of companies, guys, all right? And one of the ways you can do this is by using a, what do they call these? I'll tell you right now. Oh, a screener, I'm sorry. So this is FinViz, and they have a free stock screener. But usually when they're free, they have they're not as robust as far as features are concerned. So I will use, and whoever your brokerage account typically will have a screener as well. So if you look at my screen, you can see their stocks right here. If you go to news and research, okay, and then you go to stocks, you're going to go to this screen. Here's the screener tools. So start a stock screen. And there's going to be more options, probably more options here, because Fidelity makes money off of you. Unless you're paying for FinViz, you're going to have a limited Yeah, see how even this trades is elite only. Okay. If you're looking at my screen, you can see like it's only one feature that I believe. No, they have fundamentals here. There's actually a lot to choose from here, actually. But like ETF is super limited. Yeah, there's actually a lot here. Not as much as with your brokerage, probably with Fidelity, but there's a lot there. So if we look at, what we're screening for, again, we want something that's going to grow over the next 5 years. So let me see if I can do this with the free one with FinViz. I'm going to zoom in. Whoops. There you go. All right. So if you want something that's going to grow, like you want a stock that's going to grow, like you're a value investor, you want to do mid and small caps, maybe large caps, okay? Because the probability that Amazon doubles next year is like, it would have to be insane, because it's already a $1 trillion company, right? Now, a company that's worth $10 billion has the opportunity, it has more likelihood, depending if it's a good company or not, of doubling in the next couple of years from 10 billion to 20 billion, or from 200 billion. We saw Nvidia 5x in a year from 200 billion to trillions, right? So if you're looking for something like that, you probably want to look at mid caps, large caps, small caps, okay? If you're looking for something like I am, which has volume, has potential to grow, I like to look at large and mega caps, all right? So we'll do large. EPS growth the past 5 years. We want something that we know has grown. And so you can put over 15% or over 10%, but I really want future growth. And I doubt they're going to have that here. Let's see. Oh, growth next 5 years. Okay, so this is the number that we want, and we want this to be over 15%. All right. Remember, they wanted it to be a PE ratio of under 15. Okay. We can do that, but if we do that, that's going to eliminate a lot of our tech. And so I'm not going to do that. I'm going to go to PEG ratio, and I'm going to go under 1. Remember, it says it here. It says it in module 1. Under 1 is what's best. So let me just make sure that I put here, even though it's in the first lesson or in the previous module, we'll put it here as a reminder, make it more convenient for you guys. Perfect. So under 1. And then my next screener is, yeah, do I like the CEO, but that's okay. We're going to go ahead and start this. And you guys can see there's only 8 companies left. All right. There's only 8 companies left. So I'm going to put any on this one and see what pops up. All right. Now we have more of a list to look at. So we can look like at Ally Financial. What I like to do is go look to see if there's any brands that are familiar to me. Look, you have Carnival Corp, Coterra, DaVita, Citizens Financial. I don't like banks. You have, Fidelity, First Solar. If there's any companies that you like, that you use, Micron's probably a good one. I like Micron. Let's look at Micron. It's starting to grow. Now, it's MU, the stock ticker. So I'll go back to Qualtrim, and we'll take a look at this company. And so we can see it grows. It's a little bit all over the place, but it is growing. If you know about Micron, you know it's part of it's an important part of, and it has a lot of partnerships with semiconductor companies. I don't love the financials right now. the free cash flow, the EBITDA. This doesn't look beautiful, right? We're looking at the debt. So it's not, I'm not saying it's not a good company. It's probably a good company, and we can write it down, but I definitely, just looking at this, I need to do some due diligence. I definitely need to do some due diligence. Not saying it's not a bad company, okay? But that's the gist of it. And so you need to look at as many brands as possible now, and that's how you're going to start creating your watch list. That's how you're going to start creating your watch list. I like to do a combination of this, watching other YouTubers that I trust that have already done their research, like Joseph Carlson. And then I'll go do my own due diligence on those stocks. And FinViz is free, but you can also use Fidelity. FinViz was very easy. I like it. Now, once we've done that, we have to see if we trust the CEO, which you can look up the CEO, Google him, ChatGPT him, YouTube him, all that good stuff. And let's just say we ended up keeping MU, all right? MU is going to be the one that we stick with. All right, so next, we're going to use our valuation formula. And I'm going to show you guys the easiest way to do this. So how you evaluate a company is expected return, okay, is earnings yield plus growth rate equals expected return. You want to go with the highest number. So if you go through 5 companies and you use this formulation, the company with the highest number is probably your best bet, all right? So we're going to use this formula. We're going to use this formula to evaluate MU. And all I'm going to do is I'm going to use ChatGPT. I know it's so difficult. It's so difficult. All right, so this is what I wrote into ChatGPT. You guys can see. Okay. I literally just copy and pasted. I said, can you use this formula to evaluate Micron? Okay. And there's the formula, and let's see if it spits it out for me. And we can check the sources to make sure that the numbers look accurate. And here we go. And we can fact check this as well. What the forward EPS is, the current share price. Let's see if the current share price is right. 95.85. Let's go back. They got it at 96. So that's close enough. You guys can see the number they got was 4.36%. So we're going to write that down. And we're just going to do the same thing with every stock that we find. And the one with the highest number is the one we're going to go with. I'm sorry, 77.97 is the number. Okay. That's the number that we're going to go with. All right. And so if we look at 5 companies and 77.97 is the best number, well, that's probably our best option after we've looked at everything. But if they're all high, just put them all on your watch list because it doesn't need to be perfect. That's the beauty of this system. Remember, we're just collecting premiums on them. So if you're doing 5 different companies and 4 out of 5 do not assign the shares to you, that means you just collected premium of 4 out of 5, and you only have to worry about continuing the wheel with the one put that assigned the shares to you. All right, I'm hoping I didn't confuse you guys. Now, This is just a quick chart to show you guys peg ratings. Remember, we're okay with fair value when we're selling puts. We're okay with it. So anything actually, I was showing you guys great companies under a 1 peg ratio. But if it's 1.5 or 2, if it's fair, shit, we'll probably do those too if we have conviction in that company and we're okay with holding that company long term. Sometimes there's going to be markets where you're not going to find excellent or good value. You might just see fair. And so you just have to make sure that your risk management, let's say, you're using a 0.2 delta, 0.3 delta, use a 0.2 delta on something that's fair value. If it's an excellent deal, use a 0.3 delta, collect more premium on this. You have to use your own due diligence to decide what the best choice is for investing. So here's an example screener where you guys can see the PE ratio of Apple is 25. That's great for a tech company. The PEG ratio is 2.5, so it's overvalued. Even though the PE ratio is super low, guys, look at NVIDIA compared to Apple. Way higher PE ratio, which means if you were only looking at PE ratio, this would be way more overvalued. But if you look at the growth rate, expected growth rate, and you look at the PEG ratio, it's actually a good value. So we should be selling puts on NVIDIA right now, which I'm going to do right now. Shout out to this, right? Microsoft is showing overvalued. Palantir is fair. Amazon is fair. Let me go sell some puts on NVIDIA while we're here. Okay, and so here's the takeaways before we do that. All right. You always start with the 3-question filter. You use the PEG for tech, and you use PE and earnings yield for other sectors. You calculate your expected return before investing. You can use Qualtrim or any other, there's free sources too if you want to, or you can use Fidelity to look at all the financials and all of the stuff, that the data that you want, the metrics that you want to look at. Only sell puts on companies you'd be happy to own long term, and sell covered calls if you get assigned, or continue compounding into your base, or just hold the stock, right? So here's the valuation checklist. 1, apply the 3-question filter. 2, calculate earnings yield and growth rate. 3, use PEG for tech stocks. Check valuation tools on Qualtrim. Decide, are you going to own, sell puts, or are you going to move on? That simple, guys. That simple. And so with that being said, guys, there's 2 bonus lessons here. We've already kind of gone through how to read financial statements. This goes deeper into it and gives you examples. You're more than welcome to go check that out on your own. And then tax strategy 101, same thing. You can look at this on your own. But I highly recommend checking out, talking to an accountant or CPA to help you with this stuff if you're going to take this serious, okay? So that's it for the stock investing course. While we're here, let me go ahead and see if NVIDIA is still a good buy right now. So we're going to go to Fidelity. I need to go to my watch list, go to invest, watch list, and let's check out NVIDIA. Sheesh, it's up 3.64%. I don't like that. But it's gonna, I think it's gonna get to all-time highs again. So freak it. Let's see what happens. All right, so it's at 134 right now. Let's look at the delta. 120. Okay, that's not bad. 120 strike. And the stock is at 134.63. And the premium for that 0.2 delta at 120 is $2.50. And that's at a 0.2 delta. Okay, so here's my my screen of everything that I wrote down. Let's do the math on this. 100 divided by 120 times 2.5. Yeah, it's a 2% return. Let's do it. Let's do it. Let me see if I can do 3 contracts. All right, guys. So we got 3 contracts. Let's place the order, and we're in there. So I have a whole bunch of stuff that's expiring June 13th. Let me just make sure that that is June 13th. Yeah. So I have 1, 2, 3, 4, 5, 6 puts that expire in 30 days. So now I'm just chilling. I'm literally just chilling while my machine is dollar cost averaging into QQQ and into VOO, and I'm putting 1,000 a week into the brokerage, and out of that 1,400 is going into my base. So now I'm just chilling, seeing if the premium, if I get realized gains, if I can collect those premiums and they're realized and I can close those puts, then I'll go ahead and continue building my portfolio from there. But I'm happy with the positions that I'm in right now. The market looks bullish, and yeah, that's the stock investing course. Some of this stuff might have went over your head. What I highly recommend is watching it again. And any questions you have, man, Google it. Comment below the questions. ChatGPT. Go actually press buttons and experience this stuff. And if you want more, okay, you can, I just started this, and it's only going to be $15 a month. It's not going to be a stock invest. Everything that I'm going to put out, I'm going to put it out for free on my live streaming channel, and then we're going to clip it on my main channel. But what I think I'm going to do is I'm going to teach you guys how to at least create your first foundation, which is building businesses. Building businesses. So if you need help with building businesses, take a look at this school right here. It's only going to be $15 a month. Right now, there's a 7-day free trial. There's nothing in it yet, but we're building we're going to build the curriculum, and then we're going to build the community. And I'm going to teach you guys a whole bunch of stuff, but I'm also going to give you a free CRM so that you can control the marketing of your business. I'm going to teach you how to run ads, paid ads. I'm going to teach you how to scale your business, how to run an FBA store, a Shopify store, how to build a brand. All that good stuff is going to be in here. So if that's something you're interested in, you're going to get software, and you're going to get courses and a community for $15 a month. If you got any value from the stock investing course, then you'll get a lot of value from the snowball. And again, like I said, there's going to be this is great for people who need to build their base. I couldn't stress it enough in the beginning of this course, how important it is to have a strong foundation. The main thing needs to be the main thing. And so the snowball is going to help you build the main thing so that you're making so much income, you could really take advantage of building wealth using these stock investing strategies. And I'm even going to like the real estate stuff, I'm going to do for free on my channel as well. But for the foundation, if you want to build a business that's going to unlock the opportunities to do the real estate, to do the investing in stocks, to scale your businesses even more. And you're going to see that for free on my channels. But if you need help getting to the next level with your foundation, the snowball's for you. Good luck, guys.